Hi, this is Brant Cooper. Welcome to Lean Lunch. I'm so happy to have my good friend and Lean Startup OG buddy Dave Binetti on the call. So our idea around these Lean Lunches is to have people that are actually making impact on large enterprises, either from the outside or from the inside. But this isn't about adopting a philosophy and checking a box, say, yeah, we're doing lean innovation. This is really about making an impact on businesses. And so that's what Dave does, and that's why we have Dave on the call. Dave, I don't remember like when we first met exactly, but you were part of a very small group of people. We were hanging out on a Google group and maybe going to the first Lean Startup Circle the Rich Collins put together in San Francisco. This is like the late 2000s, and just a handful of people actually trying to put some of Steve Blank and Eric Ries's principles into play. So that was it, right? Welcome.
Thank you, Brant. It's great to be here. Yeah, it's been 10 years, if you can believe it. That's when it started for me, when I first met Steve and fell in love, and then subsequently met Eric and you and Patrick and Ash and Rich and Cindy and Sean, right, all the people that were there, and so it's just funny because I tell the story, and you can certainly appreciate how hard we had to work just to get startups to start to pay attention to this. And now look at us, all grown up, talking to the Fortune 500.
Exactly. So maybe you can give our audience a little bit of background about where you were when you were first applying these principles, because you were the quintessential lean startup entrepreneur.
Yeah, wandering in the wilderness to start, right? So for me, it was a pretty simple thing. I'd been at that point, 3-time entrepreneur. Incredibly frustrated because all of the tools that they taught me in business school weren't working for some strange reason, and I was just beyond measure frustrated because there wasn't any alternative. And my wife at the time was at UC Berkeley taking classes, and she said, "Look, Dave, you've got to read this book. I've got this Berkeley professor who knows entrepreneurship." And I heard Berkeley professor and entrepreneurship, and I was like, "Yeah, no, I'm not going to talk to that guy." But she finally kept hounding me, and she's like, "Look, you either have to talk to this guy or read the first chapter of his book, or I'm just not going to listen to you complain anymore." And so I grumble. All right, fine. And at this time, it was just a manuscript. But I read the first chapter to what eventually became 4 Steps to the Epiphany, and just like, oh my God, life-changing. Met Steve later that week, and as they say, the rest is history.
Awesome. Yeah, that's amazing. So I actually got started about the same time, 2006.
Yeah.
Launched a marketing practice called Sales and Marketing R&D. And so it was, how do we apply engineering processes to sales and marketing? And I hadn't actually ever heard of Steve Blank. And then when I started blogging about that, I think it was like 2008, because I had failed miserably selling this into startups because they didn't want to hear this stuff. Somebody said, "Oh, you should go check out Steve Blank's stuff." And I had the epiphany, right? It was like, oh God, he's got it all figured out. So
yes.
Yeah, so that's awesome. We've come a long ways. We can maybe talk about it later, but I actually think large enterprises apply this stuff better than startups do. So I'm not sure exactly why that is, but here we are. We're inside the
Brant, that's obviously as a result of your excellent consulting practice.
Oh, okay. Yes,
so,
thank you. All right.
You don't have any insight into the people who weren't talking to you.
Right, that's true. But so it turns out, right, so Steve Blank's famous line, startups are not small versions of big businesses, right?
Yep.
So back in the day, we were teaching startups how to act like large businesses. Mm-hmm. And so startups were failing miserably. What I didn't realize back then when I heard that is those methods that we were teaching to startups were also failing miserably inside of the large enterprises. So it wasn't even that we were taking enterprise best practices and teaching them to startups. We were actually taking how to do innovation wrong and bringing them to startups. So I think that was the opportunity that we then found was, if you go inside these large enterprises, what you see is that the innovation side, or doing things differently, or being more agile, or being closer to the customers was broken as well. So I do a talk and I open up often with what are the two questions that you hear inside the large enterprise that kills innovation, kills breakthrough innovation especially? And it's, what's the return on investment, and when am I going to see the return?
Yeah.
And the only way to answer those questions honestly, at least truthfully, is to go and look at the incremental side of the business, the sustaining side of the business, and make incremental improvements in the known market where you can justify that you're going to see an increase or a modest increase, and you can show that I'm going to get a return for whatever activities I'm doing on the sustaining side. Can't do the breakthrough stuff because we don't know what the return is, and we can't measure the progress based upon return. And so this gets us to innovation accounting. How do we actually measure progress differently than the execution side of the business, which can be done pretty much by return on investment?
Sure, absolutely. Yeah, no, I think you've nailed it, right? I mean, that is, and this is an area that has interested me for about 5 years. After we started to see startups apply these methods, and then it started to, we started to get calls from these large organizations and say, hey, we'd like to employ these principles, and we struggled because there were these key questions, and the crystallization for this for me was when I was working with Eric Rees on a project for one of his clients, and we're doing all the stuff and giving a workshop, and then when a product manager comes up and says, great, I love this, I think this is fantastic, and I've just got this problem because corporate's coming to me, and by the way, corporate never attends these workshops, and says, hey, what's the ROI? What do I tell them, right? And Eric's answer is don't. It's a trap. And he's totally right. Don't get me wrong. It's absolutely a trap. You shouldn't answer the ROI question. But, it's just a lot easier for Eric to say that than it is for a, product manager who's got, been in the company 10 years and has to go tell finance, no, go pound sand. Like, right. That's not going to work. And so inevitably they do one of three things. One is that they don't produce the ROI, which is, okay, great, no funding. Second is they produce a negative ROI, which is the truth. And that's easily like, wow, you just made my job super easy. No funding, and I'm going to look at you very closely in the future because you must be nuts for proposing negative ROI. And so the only other option remaining is that, okay, just lie. And so they lie, and they produce revenue forecasts for things they have absolutely no idea what it's going to be. And of course, finance knows that they're lying, so they discount those estimates heavily for the riskiness of the project. And of course, the product manager knows that finance knows, and so they bump up the revenue projections even further to account for that internal discounting. And so what you've got is this just incredible race to ridiculousness that almost always winds up in the same situation. Like, what happened? Why didn't you deliver those ridiculous forecasts that you promised me? This project is a failure, and you know what? You're probably going to be fired. And so that's the sort of like path to disaster, ROI disaster that we see. And the reality is that's actually not even the worst scenario. The worst scenario is that everybody knows this is happening to begin with, and so the product managers just never innovate. They just never do it because they understand how this game is played, and they know they're going to lose in the end. And so as a net result, you have what, in my mind, is the innovator's dilemma, Clayton Christensen's famous innovator's dilemma, where firms are caught in incremental progress because it's the only thing that they can justify, and they're not willing to take chances on anything else. Because if you're a product manager who has this fantastic idea, you can propose it, take all of the risk, likely miss your targets, and get fired, and that's the downside. And if you're successful, you get a pat on the head and say, thank you, that's exactly what you were supposed to do, good job.
Right.
Or you could take it and start your own company and still have all the same downside, still likely to fail, still won't have a job, but the reward is just like 10 to 12 orders of magnitude better, right? And so, they're not stupid, and the economics dictate that these firms not innovate because of the individual incentives on the managers, and so they get caught in the dilemma, and they go away slowly and quietly.
Yeah, so it's what's interesting to me about it is this notion of building a collusive house of cards
Yes.
that
Yes.
everybody kind of knows that they're playing
Sure.
this. It's a Kabuki theater
Sure.
of innovation.
Yeah.
And there is another scenario where innovation is attempted, and it doesn't come from the product manager. It typically comes from someone senior, and because of their power or their influence, they say, okay, this is the path that we're going to go down. Uh,
Yep.
Back in the 90s and 2000s in particular, this usually came out of very technical companies where they have an R&D center, and all of the engineers and scientists are actually building innovative technology, and then the management team kind of waltzes through this lab in the wilderness, is what I call it, and go, okay, we're going to invest in that one over there, and that one, and then spend tens of millions of dollars trying to productize these inventions and fail. So this other scenario building being that they heavily invest in innovation in some ways that is doomed to failure from the beginning because it's not a lean startup, because there's no evidence in the marketplace. It's because they are building something that nobody wants. And
Yeah,
somehow,
they're very good at addressing the technical uncertainty, and they have no set of tools to address the market uncertainty. And
right.
the test is uncertainty, right? That's the test. So if you can make predictions about the future, and this was also from another engagement of mine where I got, where I was handed myself pretty solidly on a platter. So I'm coming in, I'm trying to teach him lean startup, and this is the way you got to do things. And he's like, look, son, I've been in this business 30 years, and I know that if I improve my product by 10% and reduce costs by 15%, I'm going to get 7% net increase in sales. Like, I know the elasticity of that curve, and I have absolute confidence in it. I've done it forever, and like, just shut up. Like, I'm not going to try all this shit. I know the answer. And he did. He clearly
Right.
knew the answer.
Yep.
But he was in an established business where he was fundamentally trying to do incremental, continuous innovation, which is what these companies wind up doing. And as long as the world is stable and their fundamental core business doesn't change, that's great.
Yep.
Of course, it doesn't account at all for any type of discontinuous innovation. So any significant break in that from the world, from technology, from regulation, from legal rulings, from social unrest, from social trends, any of those things, and the fundamental business is destroyed with no capability of responding. And so we try to address that latter piece, and it depends on the horizon that the company is in.
Right. So great segue into how to apply what metrics at what time, what phase of the business. So there's a model invented, I believe, by McKinsey's
Yeah.
in the early 90s. I think it was
Steve
updated by
Cooley. Yep.
right, and then eventually updated a little bit with Jeffrey Moore. I think what Jeffrey Moore discovered was that the sort of the linkages between the horizons weren't as good as what he imagined, and so he sort of did an update to the model. And then I actually wrote about it in the Lean Entrepreneur because Intuit was the first company that I had seen where they took Eric's concept of innovation accounting and applied that to how you can measure companies to determine where they are in the three horizons. But maybe I'm jumping ahead. Why don't you describe the horizons?
Yeah, so why don't we actually just do a quick primer, and I've got a few screenshots here. So let's see if this helps. And is that working?
Yep.
Super. So for those who are not familiar, the Three Horizons concept was developed by Steve Cooley at McKinsey, and the basic concept here is that, look, you have your standard product life cycle, and it should look pretty familiar, right? You have this start of your company, and then you develop something. The cost curve here is obviously left unstated, but you spend some money, and then you launch, and you have this wonderful hockey stick, and then you make a large amount of profit as it's in maturity, and then eventually it declines and is end of lifed. And so you basically break that down into three separate facets. You have Horizon 1, which is the place that we all want to be, and that's where we're making large profits in our stable business. It's what the company is known for. It's what their brand is. But of course, these things don't spring out of the earth fully formed. And so before they can become Horizon 1 profitable business, they've got to grow. And so here's where you have the hockey stick, and that's H2. And so while in Horizon 1, your primary goal is profitability, so you use metrics like IRR, return on invested capital, just general measures of profitability. Horizon 2, you're looking to grow so that you can establish some strategic competitive advantage. And so here you actually care much less about profit. You see we're losing lots of money, but we do care about top line. So top line revenue, user growth, market share gaining. That's the goal for Horizon 2 at the expense of profit. And Horizon 3, of course, before something can grow, it has to exist. And so this is the innovation phase where we come up with ideas and we're searching for product market fit that happens here. And so typically here, we measure things in the only thing we can, which is cost. I'm going to argue that there's a different metric that we should use, which is option value, which is really the place where this innovation accounting framework that I've developed came from. But this is a useful shorthand because the governance models in Horizon 1 to Horizon 2 to Horizon 3 are very, very different, right? You want managers here, you want to protect the brand, you want stability, you want predictability in Horizon 1. Horizon 2, you're looking for growth and things are brittle and they're breaking all the time because you're growing too fast. You don't care about profitability, you're looking to grow as fast as you can, you don't care what money it takes. H2 is what we traditionally consider startups in the media because they've already made it and are growing. Of course, Horizon 3 is where most startups are, and frankly where most startups fail, where they're trying to do their ideation and implement it and produce something that has product market fit. And here you're trying to do creative and do new things and really not care about stability and profitability because they don't exist. So the three horizons.
So could I jump in there real quick?
Yeah, go.
Yeah. So the other thing that I wanted to point out, sort of in the way that I've modeled things, is the H1 is you look at it from an innovator's dilemma point of view. The H1 is Clayton Christensen's sustaining innovation side of the market. Market is very well known. Problems are known. Solutions are known, and it's actually where if somebody wants to apply lean, they're applying lean more in a continuous improvement environment, right? So that you're actually increasing efficiencies and lowering costs that way, and perhaps actually doing innovation on parts of the business model that make yourself more efficient and get rid of non-value add activities and that sort of thing. And then the H2s are, in our framework, in the Moves the Needle framework, is that you've got your financial way of looking at it, but also in terms of the businesses that are actually, the startups that are actually in that phase, we're measuring things like month-over-month engagement growth, or have we discovered how to create passionate customers, and we're starting to look at business model metrics. And the H3s then are the very early measurements of how many users care, how many users are coming in and buying the product, do we get repeat buys, and so they're very early stage metrics. I also often add an H4, where H4 over in the R&D world is invention. And so back when McKinsey built that framework, their H3s really were more around invention. And so we want to understand that patents are a poor way to measure innovation. Patents measure invention. And it's like a classic, not to go down another rat hole, Dave, but patents are corporate vanity metrics because they don't show anything that's not necessarily correlated to revenue growth, because they stop at the vanity metric. They stop at number of patents they've invented. They have not yet brought that invention to market, so they therefore have not yet innovated. So that's my H4. I'm inventing a model. I can't leave anything alone, Dave.
Yeah, so, and just make sure, am my video coming in? Just want to make sure my video is coming in.
Yep.
Great, because I switched off screen share. Yeah, so, that sounds great to me. I'll tell you my approach. Lean startup as a process addresses the market uncertainty versus technical uncertainty. And so the differences between those two, technical uncertainty is, can it be built? Right? Can you create a patent? Can you make that widget do its thing? Market uncertainty is, will anybody buy it? Can you create a sustainable and scalable business model on it? And so the sort of absurd examples of this are, teleportation, or curing cancer, or anti-gravity. Like, these are very, very difficult technical problems. But if you could solve them, there's no question that people would pay you to be teleported around the world or to have anti-gravity devices. There's like you're facing pure technical risk, as opposed to market risk, which is, well, we've created this website that's Airbnb for cats. There's no technical risk associated with that. Yes, you can build a website for cats, cat sharing. Like, that's not an issue. The issue is, can you create a sustainable and scalable business around it? So I find most entrepreneurs, because they tend to be engineers at the early stages, tend to focus on the technical risk, not understanding that the majority of what they face, in most cases, is market uncertainty. And so they continue to reduce the scope and size of their technical risk, not realizing that it's not relevant, it's not the most sensitive variation. So for technical risk, I recommend Agile, Scrum, extreme programming, these well-known techniques that we have. And for market uncertainty, recommend Lead Startup or some other iterative market-based learning approach.
Right.
The only place that I would differ from you, having a fourth, that's great. For me, 3 is innovation, and innovation is both. It's what we traditionally think of, ideation, like coming up with a cool idea, the patent, your Horizon 4, but then implementation, like actually doing it and figuring out if those assumptions you made are right or wrong. And so innovation is ideation plus implementation. If you skip the implementation part, then it's just R&D. And R&D is important, but as you know, as I've already articulated, R&D without the actual implementation is like just a cost center, right? So.
Yep, I totally agree. And I think that it's one of those things like you mentioned technical risk. The hardware-based companies go like, oh no, I can't do this lean startup stuff because I have to build hardware. And I go, you're already prototyping, right? You're prototyping in order to reduce the technical risk. Take that same prototype and bring it to your customer. And this is actually what GE has found, right? They take their prototypes that were originally built for technical risk, they bring them out to the customer, and the customer literally says, stop developing, I want it now. Oh, no, we've got this whole specification we have to complete. No, stop, give me, I will pay you. Market risk, overcome. So.
Yeah, no, I think the best example of that is Kickstarter. Like, Kickstarter removes all market risk from the equation, right? And all that's left is technical risk. Now, can you build the thing that you promised? And so I think models like that we're going to see in greater prevalence because it just eliminates the market uncertainty.
Especially with digital fabrication, that certainly lowers the cost.
Yeah, and that's going to be true of so many more industries. Yeah. So, but the Horizon 2 for me are definitely hard metrics, right? Horizon 2 are definitely hard metrics, and not like I'm actually talking about like user growth.
Agreed.
Like actually money. Market share. Like, I want to see real stuff here.
I want to see cost of acquisition, lifetime value. I mean, a lot of the metrics that actually the startup world uses, post investment, that measure, that this is actually a scalable business.
Yeah, cost of acquisition is Horizon 2 metric essentially, and then you're making a proxy for Horizon 1, and so that's actually kind of where I think this is kind of useful, so that you understand that you have, in a particular horizon, you have something that you are both looking for or that you need to maintain. And so in Horizon 3, you're looking for growth. Like, you're looking for product market fit so that you hit your hockey stick and growth starts to take off, right? But what do you need to maintain? Nothing, really. You don't have any profit, you don't have any users, you don't have any systems. This is the advantage that startups have, because you can actually do all of these things and you've got nothing to maintain. You just have to search for growth.
Right.
Once you make that transition to Horizon 2, now you've got a new problem, because now you need to both maintain your existing growth, but you also have to find profit. And so once you make this crossover, which is typically when you have either your proposal in at a large company or you take a Series A investment, you're now at a race. You're at a race to maintain your growth, and you have to maintain that growth or find profit before your growth slows. And this is where Twitter is right now. Right? Twitter is slowly slowing down, or the growth is slowing down, and so investors are demanding profit, and they haven't found it yet. So
Right.
they're in a crunch here. Whereas somebody like Uber is still fat and happy because they're growing like mad, and as long as they continue to grow, they can forestall the profitability. Finally, once you move to Horizon 1, then you need to maintain your profit. And it doesn't mean that you can't grow or shouldn't grow. It just means that you're not going to grow at the expense of profitability as you would in Horizon 2.
Right.
And so, as you mentioned before, Horizon 3 is where you have this discontinuous innovation, and then Horizon 1 is where you have the continuous innovation and the incrementalism.
Yeah, those are nice charts. I like that. I think it's important for people to understand that you're finding growth in that phase, and so
Yep.
and even in the H2s, you're learning whether you can be profitable. It doesn't mean that you have to start being profitable. And so this is where people get confused, because they're all, sort of the investment banking world goes like, oh, well, Uber it hasn't demonstrated profitability. Yet Uber knows very well, based upon how they're paying drivers and the fact that maybe even drivers will go away, this isn't something that they actually have to solve right now. And so it's important for the larger enterprises to understand that there are times when you have to say, okay, now we have to be profitable, versus understanding the ability to be profitable.
Yeah, I mean, really it comes at peak growth, and you can't really necessarily estimate that easily, but that's really when you need to start understanding before you get to peak growth, because anything is just a logistic S-curve, right? I mean, that's just life, and this is true of any business. It's just of course the non-cumulative version of the product life cycle, and so you have to find that profitability. But as long as you're growing, you're going to get a pass. Like if you continue to grow
Right.
at a cost of acquisition that is anticipated to be less than your lifetime value, then you will be allowed to grow as long as you want. You will not need to be profitable, right? And that's why Uber's valuation continues to go up, even though they're losing money hand over fist, because the investors in the market realizes that, yeah, but they have durable value here, and we want to just make sure that we have a larger strategic positioning, strategic advantage in the marketplace. And so they're very happy to continue to fund their very unprofitable business because it's growing like mad. If that growth stopped, then they would be expected to turn around a profit very quickly, or else their valuation would sink like a stone.
Right. Yeah, and so I think what's a great message for the audience here is, I sometimes get the feeling that people, the moment you take ROI out of the equation, people go, oh, how are we going to hold the teams accountable? And so I think this is the method, this innovation accounting at different levels based upon the phase of this innovation effort, how you're actually measuring the progress and how you're holding the teams accountable. It exists, and it changes, it evolves as it grows. But there's nothing in what we do that suggests that these teams are out doing 10% free time and nobody's going to hold them accountable for the business that they're growing.
Yeah, I think the Horizons model is incredibly useful as providing a shorthand to be able to tell people where you are. Because I mean, I go into organizations and I ask them, like, where do you think you're at? And they're like, oh, we're definitely Horizon 3. Oh, no, we're Horizon 2. Oh, we're Horizon, and then 1. These are all the same teams. Or you have the example where a company's like, I'm trying to find out what horizon I'm in. And I start to ask them some questions because I have a heuristic to figure that out. And then I answer the question. I'm like, okay, well, you're in Horizon 1. And he said, no, wait, you don't understand. I'm doing all this, fancy R&D, and I'm innovating, and I'm, testing all of these things, and I'm putting them out in the market, and so forth. And I'm like, yeah, no, I get what you're doing, but you told me that you're measured by profitability, right? That's how, when you get to quarter close, they look at profitability. And he's like, yeah, that's true. And I was like, okay, well, then you're Horizon 1. You're screwed, but that's a different story. Like, I mean, you're totally effed. You should go find a different line of work. But you are how you are measured, right? And so, and that's part of the reason why we have this problem with innovation today. Because again, if you go back to the product life cycle, right, you will see here that, again, here we can measure profitability, and here we can measure growth, and here all we measure is cost. And so, please raise your hand if you know what we do with costs in a large enterprise. Anybody? Anybody? Right? And so, ultimately these people get turned off because they're not seen as producing results, right? Which is what we demand of our organizations. When in fact, that's not the purpose of innovation. The purpose of innovation in the context of a larger company, not a startup, in the context of a larger company, is to provide optionality. It's to provide a hedge against your existing line of businesses should they be disrupted unexpectedly.
Actually, even if they're disrupted expectedly, I'm going to argue, because a lot of this disruption you can actually see coming, and if you're lucky enough to see it coming, maybe it takes a little bit more persuasion to start solving for that now. And a matter of fact, that's actually not a bad segue into how does a C-suite justify to their shareholders, hey, we see disruption coming. It's pretty clear that it's coming. There's this whole mythology around that some people even argue that it's legally required for businesses to maximize shareholder value. It's a nonsensical notion if you don't tie a time frame to it, because the business practices for maximizing shareholder value over a month, a quarter, a year, or like Honda, 500 years, obviously those practices are going to be different. And so, but this is also sort of the quarterly environment that we're in, right, for the public companies and even private companies. So how do is there an innovation accounting approach that we can go to Wall Street and say, this is how we're going to justify an innovation investment that you've already pointed out is going to go through 3 horizons or 2 horizons at least before we get to measuring the profitability?
Well, so I have a slightly different take on that, and
okay.
So I mean, you're absolutely right, but I do think that for the most part that is already baked into most shareholder value. I mean, certainly in public markets where the information is readily available, because every stock price has its book value, right? What is actually worth on the books. Like if you take all the assets and all the liabilities and the remaining, like that's what it's worth, but that doesn't reflect the stock price. Why? Because the stock price has an additional term in there, which is for those of us who went through finance, it's called PVGO, present value of growth opportunities, and it's the portion of the stock price that represents the current valuation as per the market of all of the growth opportunities of the firm, right? And so the market is providing that incentive to people all the time, right? And so that's why you'll see stocks have dramatically higher valuations than what is their book value or their profitability, or certainly their negative PE ratios, and like, where is this value coming from? Well, it's because we see future growth here, and so we know future growth turns into Horizon 1 eventually. So we see a lot of Horizon 3 potential here that we think is going to turn into Horizon 2, which, by the way, is then going to become Horizon 1. And we're going to discount all that value to the present today.
Well, how do we know that present value of growth number isn't just based upon sustaining innovation?
Oh, I mean, it could be based on sustaining innovation.
Then you don't necessarily have H1s and H2s baked into there. I mean, so my counter to what you're saying is that, for a lot of large organizations, the innovation is seen as overhead and they don't have very much budget. Whereas if they had actually been able to justify an investment in there, then that would be, a not insignificant part of their business. And so, go ahead. Sorry. No, here you go.
No. So I think that's right, and I think that the way that there's two. So I provided a valuation framework that actually gives them an actual calculated number, right? And so we can go into that whenever the time seems right. When I tell them at a higher level, just to sort of grab people's attention, is I come in and I say, look, what you're doing here with your innovation is you're protecting your existing business, right? We all want our existing Horizon 1 business to last forever. We want that profit to go on ad infinitum. We want more of it, right? And so, like, that should be ultimately what we're looking for. We just simply know that that's not realistic and that things are changing all the time and it's an uncertain world and we're having higher degrees of instability. So to simply say, look, we're going to just rely on that and not do anything else other than our existing business is really the core of what the Three Horizons model was designed to answer, right? So this is the original Cooley formulation where it's like, look, you have like 70% of your business here, but at the same time, you also want to be doing an H2, because if your H1 business goes away, you're not going to have time to spin this up. And then, oh, by the way, you also want to have some H3s in the works, and they recommend 10, 20, 70% of your attention. And so the best companies, the ones that have long-term stability, are the ones who balance this out, so they have a variety of projects at every horizon at any given point of time, so that if anything happens, the overall notion gets smooth. And so this is the product risk portfolio theory, right, where we have this portfolio of products at different stages of their evolution, so that overall we place the entire product portfolio on the efficient frontier, which again is a finance concept that we're just applying to this market risk that says, look, we want the optimal degree of risk and return for the company so that we have long-term stability and don't just place all of our eggs in the H1 basket. And I think that the firms that get into trouble are the ones that you've correctly identified, that are too concerned with short-termism, that are too concerned with maximizing profit at the expense of future possibility. And, you know, if you want to get the highest return, bet it on black. Just put everything on black and go, right? And that will get you the maximum return. It's just not the safest bet, right? It is the riskiest of the bets. And so what we're trying to say is, look, we're having an approach that helps you manage uncertainty to reduce risk. That is the goal that we're trying to achieve. And so the way to think of an innovation project is not as an equity. It's not as something that needs to produce a return. You need to think of it as a derivative, as an insurance policy, right? It's protecting your H1 business against death. And so if people get that in their heads, then we're having a completely different conversation. Because nobody goes to the end of the year and says, you know what, that life insurance policy I bought, it didn't pay off one dime last year. That was a total waste of freaking money. I cannot believe I spent money on that insurance policy. Like, that's nonsensical, right? But what's the ROI of your insurance policy? Like, how do you answer that question?
That's
right?
Great
And that's, you know, you need to think of these as profit insurance. Right? Innovation is profit insurance. It's designed to protect your H1 business against irrelevance and removing that profit. And so if you go into a finance department and say, look, I've got a great policy I'm going to sell you. You know that big business that you've got selling cars? You know, it's worth $1 billion, right? I'm going to sell you an insurance policy. For $1 million, I'm going to sell you this policy, and if that $1 billion goes away, I'm going to pay you $1 billion. Right? There's not a single finance person on this planet that wouldn't take that deal instantly. Right? But we routinely cancel our innovation projects. I don't get it.
Right. So I think that part of what I think I hear you saying is that the mechanism already exists. The forward-thinking companies leverage that mechanism even in their dealings with Wall Street and investors, but there's this other suite of companies that, for whatever reason, aren't actually leveraging a mechanism that already exists to them.
Yes.
And so I'm thinking again, sort of this present value of growth. So if you're, is there a layer deeper that we can go that helps people construct how we're going to demonstrate or indicate what the present value of innovation is? Or do we just use the existing H1 numbers? Or how does that work? Does my question even make sense? Yeah.
No, we do not use the existing H1 numbers, right? Because the existing H1 numbers, most valuation takes place in the form of what's called discounted cash flow analysis, right? And this is typically called NPV. Net present value is the predominant measure. You can also use IRR sometimes, internal rate of return, but fundamentally they all are predicated on the exact same approach, which is something's going to happen in the future. I'm going to predict how much that is. And then I'm going to look at how much I need to spend today to make that return in the future. I'm going to discount that at some measure of risk for the riskiness of the capital that I'm applying. And then I'm simply going to look at that amount over time, because obviously money today is worth more than money in the future. And so I'm going to discount it against that cost of capital so that I can look at what I expect to make in the future and what I plan on spending now. And as long as the difference between those two is positive, then we call that positive NPV. It's a positive return on investment, and we're going to go ahead and proceed with the project. What I'm suggesting is a different approach, that in the innovation phase, when the condition and the test is uncertainty, when you cannot predict with any degree of accuracy, because you cannot predict the future when conditions are uncertain. Like, that's true by definition. And so we should stop lying to ourselves, because the market will eventually tell us that we're wrong. And if you don't believe, then you can just go ask, Segway and Webvan and Google Glass, Google Buzz, Google Wave, Google whatever, Plus, right? And Google Glass, and just say, like, why didn't that turn out the way that you expected if you can predict the future with accuracy, right? And so for whatever reason, because this lie is what we need today to continue innovating, we happily tell it to ourselves, because otherwise all of our people would just go start their own companies, which they do anyway. And so I think that the way that instead you need to look at it is as an option. This is an option contract, essentially, and I mean a financial option. I mean, you are engaging today in activity that will produce an uncertain return in the future, and you're using that as a hedge against your existing profitable business. And so that is the purpose of our innovation projects. 90% of them will not turn out, and that is totally okay. Just like 99% of our insurance policies never pay a return, and we are thankful that that's true. We need to be just as thankful that we're using these options, but we're never exercising them, because they're only designed to be exercised under problematic conditions.
Does a company that actually has proven to do innovation multiple times get to play it differently, or is it still the same?
So most innovation, 99% of innovation, is continuous innovation, right? And so again, this is the Clayton Christensen concept. And so this is the Venn diagram of discontinuous innovation. So everything in the blue is discontinuous, and everything in the yellow is continuous, right? And so this is sustaining innovation. This is what most innovation is. And that's just the incremental improvement, and you get better, and you're ruthless with your efficiency. And the better that you are here, the more profit that you make, and the more that you're able to keep competitors at bay. And so the companies that survive and survive are the ones, and thrive, are the ones who do the sustaining really, 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 really well. The ones that are truly great are the ones that will take some sort of revolutionary technology and find a way to include it in their business model. And that's part of the yellow curve, where it's still within the context of their existing business model, right? And so it fits, even though they have to really work at it, right? And then there's this tiny little piece that happens ever so infrequently, but when it does, it's massively impactful. And that's the disruptive innovation. And the disruptive innovation doesn't exist within the context of any business model. And so in a three horizons model, what you want your people to do, the best companies are the ones that live in H1 and systematize and efficiency and maximize the effectiveness of their existing H1 process. So what does H3 look like to them, where they're doing disruptive stuff and new stuff? It's a threat. And so the H1 companies, the ones who do that job well, are the ones who really effectively identify their innovators, find them, isolate them, and destroy them. Like, those are the companies that do their job well, are killing the guys who will protect the company in the future, right? And so that's why that three horizons model, having different people and different jobs and different governance models, is so, so, so important. Because when you're looking for stability and predictability, under conditions of instability and unpredictability, you're going to have a guaranteed failure, right? But creativity can only come from that process. Otherwise, you're relegated to incrementalism. Innovator's dilemma, once again.
Good stuff, Dave. So what do you have any other sort of wisdom to share for the audience in terms of they're a senior person, maybe even, not the product managers, but the VPs who are sitting across the table from the C-suite or from a CFO or accounting and saying, listen, we need to, we're not going to measure ROI in the traditional sense.
Yeah.
How do they get this? Is it possible for this person to put this model, or do they have to bring you in? And don't tell me that they do. No, I'm happy if they do. How do they? Is there is there a sound bite that can get the finance person, the CFO, to think about this? Maybe it's the insurance sound bite.
Yeah, I think the insurance soundbite is the one that seems to resonate the most, because as soon as they put their brain around that concept, that like most insurance policies don't pay out and that's okay, most options are used as hedges, they're never exercised, that's okay, like they serve their purpose, they're designed to reduce the overall riskiness of the portfolio. So I think that what we try to say is like, look, we can give you valuation metric for your innovation projects. We can give you a risk metric, an actual sigma risk measurement that's normalized against all your projects so you can measure apples to apples and establish corporate governance. And we can give you accuracy measurements, sensitivity and specificity that suggest how likely you are to be successful both now and in the future. And that will allow them to do their primary job, which is to allocate the scarce resources of the firm against multiple competing projects. Right. Because today, we just let the hippo decide. Right? Highest paid person's opinion, and they look at it and they're like, okay, this looks good. You bought the right Gartner reports. I like this, wee woo thing. Let's do that, right? And that's just massive uncertainty. Or if you had a different approach that says, look, here's how we're actually judging success, and it's on the basis of whether or not people are actually getting actual evidence and learning in the marketplace, but it requires a certain degree of courage, right? Because right now, we all just live in this very comfortable lie where we're all lying, and like nobody can deny that. Like if you actually start to press them, everybody knows that it's a lie, right? And so the technique that I always like to use is like, look, you just have to continue to lie more and become better liars. You're training your people to become better liars, right? To become more effective at the art of deception and self-deception, right? Because that's the only way that you otherwise can justify this, or you can accept the alternative fact that we can't know. We have to go and test, right? That's just how we figure out the answer to the question. And in the same way that you would never release a product without doing field tests, like Lean Startup is field tests for your business. Like it's not like you take that cancer drug that you developed on a computer and then like say, okay, done, let's go make it, ship it out to millions, right? Hope nobody dies. Like, but that's what we do with our products, right? We never test them. We just launch them.
Well, so I think that one of the things that we battle, and again, it goes right back to the innovator's dilemma. The managers are making rational business decisions to invest in incremental innovation.
Yes.
And their whole incentive structure is to invest in this incremental innovation. Mm-hmm. And it's not until we can get the C-suite, or even if it has to be the board of directors, to say, listen, you guys have to justify to me why you're not selling me an insurance program. You have to justify to me why we're not investing 10% of our profits into innovation, because that is what provides me the insurance. So if you can get the C-suite to say, yes, we're investing 10% into innovation, the incentives that flow through the organization, people will be happy to innovate. I really believe so. The thing I love about working with large enterprises is the creativity and the intelligence and the passion that people have for these businesses is off the charts. And so by changing the incentive to why are we not spending 10% on innovation and the incentives that flow from that, I really think that you've got a wholesale change that can happen with that.
Yeah, because like I always try to find out and start off by saying, can we go through a few of your innovation disasters? And like every company has this like never-ending list. And I'm hoping for something that has been such an incredible nuclear blast that it's left a psychic crater that everybody understands in the organization, right? And that's the technique that I use. I'm like, how did that happen? Right? I mean, how did that come about? Because this is what you predicted. This curve is what you predicted. But when you did that, you had to know that this curve was also a possibility, right? Or this curve was also a possibility, and this is actually, right? And you don't know which one it is until you've actually already started the project.
Yep.
Right? And that, in a nutshell, is what the issue is, right? And so when we try to say, look, what would happen if you're wrong? Like, what happens if it flatlines? Is this going to be another, insert psychic crater here? And then people like start to pay attention, right? Because it's like, oh yeah, I kind of remember that, because you forget it. And this is actually sort of interesting psychology here, because Brant, I want you to tell me what it feels like to be wrong. What does it feel like to be wrong?
Well,
now, and put on your normal hat, not your fail fast lean startup. like what in the real world? What is it? Does it feel good?
You want to run away from it as quickly as possible, right?
That's painful, right?
It's painful, but it's more than that. I mean, depending upon the personality, it's where the blame game starts, and it's trying to disassociate yourself from that failure as quickly as possible, so that the human reaction to it is really the most negative parts of a culture that you can imagine. It's what fortifies silos. It's what starts the blame game. So it not only does it feel bad, but it's potentially disastrous to the company.
Sure. But I want you to notice something. You actually answered a different question. Those are great answers, but they're actually answers to a different question. Those are answers to the question, what does it feel like to realize that you're wrong? Because being wrong feels exactly the same as being right. I mean, it's like the whole time that they were building Webvan, they didn't know that they were wrong. They just didn't know it. And it wasn't until they had spent $1 billion and realized that they were wrong that the pain started, right?
Well, I bet you there was a lot of people inside the company that knew they were wrong as well, but I get your point.
But all the more reason, when you justify it through a traditional discounted cash flow analysis, once you've made that prediction about the future, you are trapped. You are trapped. Because anything that you say or do to bring anything about that amount into question is verboten.
Right.
Because that's justified, that paid for the whole party. So if you were wrong about that, like we have to stop. Like there's nothing that you can do. And so as a consequence, we have the natural human reaction, which is that we put that off as far off in the future as possible, and hopefully we've actually found a different job before the time bomb that we laid goes off. Like let somebody else step on that landmine, right? And that's when the CYA happens. Oh, it was that last product manager or whatever, right? And failure is an orphan, right? But it's that simple concept that, look, being wrong feels exactly the same as being right. It's only the realization part that hurts. And so our goal in Lean Startup is to bring that up front, right? And I mean, look, you're finance, and somebody comes to you with these two proposals. Proposal number one, I've done fantastic research, all the best surveys that I could find. I hired the best Gartner analysts, backed up by Big Four consulting firm analysis. I've done all of my research, and I've estimated that the total value of this project is $100 million, right, over 5 years, right? And I have the revenue estimates per month in 5 years to prove it. And this proposal, which says, yeah, I don't know how much it's worth, and I'm not even sure I'm going to be successful, but don't worry, I'm going to fail a lot finding out, right? And like, which one of these gets funded, right? So like, this is the problem, right? And this is the problem with not giving them an ROI. Like, somebody over here is giving me a number. Yeah, sure, it's a lie, but it's a lie that I can point to that guy about when I do my job and do my financial analysis, whereas this other person is just a fucking moron, right? And of course, the moron is the one who's right. The moron is the one who's being truthful and being honest. And so these lies cumulatively produce these, I mean, not even billion, cumulatively trillion-dollar disasters over and over and over again with frightening regularity. And it's because of that accounting process. Like, it's a direct result of how we account for innovation.
So that guy's got to become an insurance salesman.
You know, it's a hard job for a reason.
So, Dave, this has been an awesome conversation. I really appreciate you joining us. Why don't you tell people how they can get a hold of your wisdom?
Sure, thank you, Wisdom. You're so kind. So, D Binetti, just search for David Binetti, and you'll see me come up. And I've got my cell phone there and my email there and what have you. I currently am helping Fortune 500 companies with all of their innovation management processes. And secondly, I'm building, and you know, we didn't get the chance to chat about this, but that's fine. We talked about all the important stuff up front. but I'm actually building software because I've come up with a valuation framework that I call innovation options that applies option pricing theory to the process of innovation, so that we actually can generate actual true ROIs, like in actual dollars, with dollars and sigma risk measurements that finance people can use to place into their product portfolio so that they can balance their product portfolio for effective risk and return, establish effective corporate governance policies so that they have the right metrics to keep their people aligned without forcing the comfort lies that create such disaster, and keep them on track so that they can innovate faster with less risk. And so for people that are, they're moving past some of the basics and they're really starting to look at and apply higher degrees, and they need greater degrees of precision. They need to actually get dollar valuations and sigma measurements so that they can have effective corporate governance policies. I'm building financial management software based on this option pricing theory so that they can accomplish just that.
That's amazing. A really important part of the equation. So again, really appreciate having you on. So thanks everybody for joining us. This has been Lean Lunch for Moves the Needle. Moves the Needle brings an entrepreneurial spirit to Fortune 500 companies. We do this through boot camps, accelerator programs, leadership development, as well as strategic advisory. So I'm Brant Cooper. You can reach me at Brant Cooper on Twitter or at Moves the Needle. And also, you might want to combine some of these thoughts that David shared with us with our 5 Sparks of Innovation paper that you can download at movestheneedle.com. So that's all the plugging I'll do. Again, David, thank you so much. Awesome to have you. Hope to see you soon. And thanks, everybody, for the Lean Lunch.
Great to see you, Brant. Thanks again.